Are you working with someone who is a real financial planner or just someone who calls themselves a financial planner? Well, by the end of this video, I'll give you the necessary information that you will need to determine whether or not your financial planner is really making the recommendations in the best interest of you and your family. My name is John Moakler, and I'm the founder of Moakler Wealth Management. And for the best advice on how to protect you and your family, subscribe to my YouTube channel and hit the bell notifications to be notified when we launch a new video. In so many provinces across Canada, anybody can call themselves a financial planner and get away with it. As an industry, we're asking for reform and regulations to ensure that the public is protected against rogue people who call themselves financial planners, who are just out there selling products, closing a deal, moving on, and leaving all sorts of mistakes in their wake. When I am in need of a specialist, a doctor who is a specialist, I'm looking for someone who has all sorts of degrees and designations after their name. I'm really looking for someone who has been to school, has put in the work, and has the understanding and the knowledge that I'm looking for. The same can be said about a financial planner. A financial planner must have designations after their name in order to call themselves a true financial planner. The first thing you need to look at is whether or not your existing financial planner has either a math or a business background, and then take a look at their designations. The first one you should look at is the CFP, or Certified Financial Planners designation. This is kind of the gold standard in our industry. The second designation you should be looking for is the CLU, or the Chartered Life Underwriter designation. The CLU is really specifically designed for working with business owners in more complex estate planning. So these two designations, the CFP and the CLU, are at least the minimum that someone should have if they're going to be calling themselves a financial planner. Starting in 2022, so just next year, if you want to take the CFP designation, you must already have a university degree. This is so important. We've been waiting for this for a long, long time, because to become a lawyer, to become an accountant, you have to have a university degree. Finally, in the financial planning world, we're moving in the right direction, and this will only protect the public further if someone is trying to call themselves a financial planner and really does not have the necessary designations to do that. I'm working with a number of client files right now, and it's very apparent as we start to gather the documents, the business owner doesn't have a clue if they are maximizing the effectiveness of their corporation and whether or not they're paying way too much taxes to Revenue Canada. This one client has a critical illness policy. And so it's personally owned, and it could have been corporately owned, but it's personally owned. And so they're making the premium payments personally. But when I gathered the documents and took a look at the beneficiary designation on the critical illness policy was actually her brother. Now, this could have been a good designation if this was a life insurance policy. But when I went back to explain to the client that I know you're paying for these premiums for the critical illness policy yourself, but if you ever get a critical illness, the way the contract is designed is that your brother is going to get the benefit of it. And so she was really pissed. And so she ended up firing her financial planner. We were able to correct it because you are able to change the beneficiary designation in that particular situation. Now, when it comes to life insurance is a no-brainer to have inside a corporation. But a number of client files I'm looking at, I'm still seeing business owners owning life insurance personally. And so let me walk you through the math. It's very, very simple and straightforward. If you're paying for life insurance personally and you're in a 30 or a 40% tax bracket, when you take that dollar out to pay for that policy, you're losing 30 to 40 cents to taxes. You get to keep the 60 cents, which you're then using to pay the premiums. If that life insurance policy was inside the corporation, and depending upon which province you live in Canada, the corporate small business rate is around 11 to 12 cents on the dollar. So that means that you're paying with corporate dollars and saving anywhere from 20 to 30% in taxes. And so if this was the situation and you did have a policy inside the corporation and you passed away unexpectedly, Your accountant would prepare paperwork. And so the death benefit from the life insurance policy would come into your corporation. The accountant would declare what is called a capital dividend. And then the death benefit proceeds from the life insurance would come out tax-free to your beneficiaries. So there's no downside to owning corporately owned life insurance. So again, the question I ask is, why are so many business owners out there still paying for life insurance with personal after-tax dollars? And the answer is, whoever they're working with doesn't have a clue what they're doing. They're just out there selling products and not understanding what it means from a financial planning or a cash flow perspective. Now, cash flow is king. And in another client example where we're doing cash flow modeling, and I'm so surprised, client after client that I sit down with, and they say, oh yeah, I've already got a financial planner. But when I start to ask questions like, have you ever gone through a cash flow exercise? They go, well, what's that? And so, we're taking a look at what their lifestyle needs are, the money inside the corporation, how they pay themselves. And in this particular client case that I just did last week, as we went through the modeling, we showed the client that we could save them $33,000 a year in personal cash flow income. What that meant from a tax savings perspective was that they were saving anywhere from 10 to 15,000 in taxes that they were always sending to Revenue Canada that they no longer needed to send to Revenue Canada. So cash flow modeling is so important. So when you're working with a financial planner, they have to understand how to do that sort of task as part of the building of the financial plan. So if you'd like to learn more about cash flow modeling and determine whether or not it's in your best interest, click on one of the links below to apply to become my client. And if you like this video, give it a thumbs up, subscribe to my YouTube channel, and share it with a friend. Thanks very much for watching today. And always remember, when we design financial plans for our clients, we always make sure their money outlives them in retirement.